thank Mehruboon for joining us and invite Manisha Gupta, our commodities editor, to give us a quick roundup of all the action from the commodity markets overnight. Hi Manisha, good morning.
Hi Sonia, thank you so much for that. Well, starting with the crude oil prices, which have come off its recent highs. Last night in New York session, we did see the Brent crude prices inch above $70 per barrel as well. But the close-in came in lower and Asia has seen some follow-through selling there. The US crude oil price is also slightly under pressure. But when you look at both of these varieties, you have 27% of gains for the Brent prices and 38% up now for the US crude. So the going has been great for this year. So one, it has been about a bit of a profit taking at these higher levels. Two, the US production and the inventory surge that we have seen in this week has been surprisingly on the higher side, and that's led the prices slightly down as well. And then it has been about the strength in US dollar also, that's taking the prices slightly on the weaker side. And then you also have the IMF and WTO expressing doubt about the global economic growth, and that seems to be playing also onto the minds of the traders, and that has put some pressure on the metal prices as well. So on metals, especially on one side, you have the US and China trade talks going well. There have been statements from US yesterday saying that they are very close to closing a deal with China. But then the sticking points really have been about the tariffs and the intellectual property theft. Those are two issues that are being sorted and talked about. The other more important is that there have been statements from Chinese officials early today morning in some media that the stimulus measures will be increased going forward to boost Chinese economy. And that has been yet another reason that you have seen the metal prices open Asia on a firmer note.
All right, thanks a lot for that, Manisha. Okay, Mr. Tulsan, I wanted to get one last question with you on Godrej Properties. They're starting a new place and new project in Vashi as well. And the stock has run up a bit, but would you still buy it?
Lata, I won't be buying at the current level after having seen a good run-up of more than 30% in this last couple of months. But the only, I agree that the data are seen to be quite attractive. But looking to the, I'm closely tracking this real estate sector maybe for last 3 or 3.5 decades. But what I've found that generally whenever the developers sell their entire quantity or maybe 80% of the data, and if any delay happens in the completion of the project, that puts the company in a very awkward position, or even causing the losses also. And now real estate companies are all seen following the project completion method as per the accounting norms. So we will not get to know, because the incomplete projects will only be showing the work in progress. The profit or loss element or maybe the reduction in the margin element will not get known. So it is very risky. Maybe from that caution point of view, I won't be too gung-ho in buying the stock at the current level. I know that every expert is taking a positive call based on the premises having sold by the company to the extent of 80-90% of their project having launched. But all the completion of those projects will be minimum 3 years down the line, 3 to 4 years, which can be a big risk factor. So maybe taking that into consideration, and on a relative valuation of the other peer stocks, maybe like Prestige Estate, India Bull Real Estate, Sobha, DLF, they are seen to be ruling at a quite cheaper level.
Okay, sir, we just have 1 more minute. If I can squeeze in a last question on VST tillers, what's going so wrong, and what would you do with the stock now?
See, I think, Sonia, for whole of FY19, I don't understand. In fact, FY18 was such a flying sales figure and all that. And even if you take the fourth quarter numbers, tractor sales are down 40%. I'm not going by the monthly numbers, which are seen to be really very bad. And even the tiller sales numbers for the Q4 of FY19 is lower by down by 30 to 33%, over YOY. So practically the whole FY19 and management have not been able to, clarify that what are the reasons. This is not the 1 month phenomenon. In fact, if you take the all 12 months figure, or maybe whole FY19, or maybe even every quarter, there has been this kind of howler performance has been seen with the overall fall of about 30 to 40% on both tractor as well as tiller. So yes, the FY19 will really be a bad year, and probably if they recover and revive from here on, then let's see what's the management commentary, and let's wait to see the sales numbers for first quarter of FY20.
Take your points, the numbers not been good. Thank you very much, Mr. Tulsan, for joining us. We'll touch base with you on closing bell. And with that, the first rates are looking not bad at all, 1/3% higher for the Sensex Nifty as well as for the Nifty Bank, and the mid-cap's actually a shade better. The advanced decline is also looking very good at this point in time. So let's reel off what's looking green, and no prizes for guessing the best stock today. Titan reacting very positively to the numbers that they have just announced about their fourth quarter, about 22% rise in volumes. And following it closely, Yes Bank and Tata Motors. So Tata Motors still doing extremely well. Cipla, the news of course is positive about them getting a clean chit from drug regulators. There's IndusInd Bank. So IndusInd and Yes are the two banking stocks that are seeing a decent amount of short covering. And then there are of course auto stocks, M&M and Hero doing reasonably well with a 1% gain. So that's the 1% club. And then doing almost as well as 1% are Vedanta, Z, Sun Pharma, Ultratech, BPCL, IOC, all of them doing well over 0.5%. It's a short red list, about 10, 12 stocks out of 50. Adani Ports, Britannia, HCL Tech, Maruti, HDFC, ITC, Coal India, Bharti Airtel, down about 0.2 to 0.5%. I mean, it's not a big loss. The market's still in the green. It's not 1/3 higher. It's a 1/4% higher, but doing decently well.
Okay, it's decently well for the mid-cap index too, up about 0.3%. The advance decline ratio is positive at 4:1 in favor of advances. Godrej Properties is definitely the stock of the moment now. It's hit a new high this morning. It's up almost about 4% on the back of that acquisition that they've done in NCR. In a company in NCR, as well as a new project that they've announced in Vashi. There's just everything going well for Godrej Properties, and that stock is trading with handsome gains today. Apart from that, you have a lot of stocks that are reacting to news flow. So let me get some of them on board. Dish TV continues to move up further after that news break yesterday, so 2% higher on Dish TV. GM Breweries and VST Tillers both have negative news flow. GM Breweries results have been weak, and VST Tillers, the sales numbers were weak, so VST Tillers is down. But GM Breweries actually bucking the trend, so up in the green right now. A couple of more stocks. VIP has had a fire at its plant in Uttar Pradesh, so that one is slightly under pressure right now, down about 0.5%. Jet Airways has some more bad news going for itself. No funding coming through just yet. So Jet Airways is down 0.7%. SRF is that stock actually has recovered quite a bit and it has hit a new high today. It's flat right now, but it is sitting at a fresh high, so keep an eye out on SRF. Couple of these auto ancillary names like Madison Sumi, etc. also doing pretty well. So Anuj, is a good opening. I mean, it's holding on to its gains. It's building on to its gains in the broader markets, and the trend is on the upside.
Yeah, the trend is on the upside. I think especially for the Bank Nifty after yesterday's decline and after the consolidation of last 2-3 days. I think keep an eye on IndusInd Bank. The move started in last 10 minutes of closing bell. That's beginning to make some kind of move. I don't know, but that's very interesting right at the open. That one is seeing quite a bit of buying, again corrected from the highs. So that is one stock that I would keep an eye on. Apart from that, the market at higher level perhaps would see some profit taking as well. So let's wait for first 15-20 minutes before we can make any judgment about the market opening itself. Ashwini, your thoughts on market opening, and is there any interesting stock idea?
Yeah, I would think that you should buy into the market, given that hardly two sectors are in the negative, and we had a fairly strong decline yesterday. My senses will first go towards 11,750 before we go to the other side. So this is a market that we need to buy, not because it's trending, but chances are that it's going to make further highs before it declines.
Okay, Nifty or Bank Nifty, Ashwini?
Both on Nifty and Bank Nifty, because people who went short home yesterday are obviously not getting the kind of follow through they may have expected. So my sense is that first couple of hours could be greener for the market.
Mitesh, your thoughts on market opening and any interesting stock idea?
Yeah. So, Anuj, I think we bought some longs yesterday around 11,565 levels. I think booked them out on, so some profit can be taken out, or you could choose to revise the stop loss around 11,600. And the stock which looks interesting to me is Bharat Forge. I think the intraday charts early in the morning are quite strong, so maybe this could see some follow through during the day.
Well, the stock of the moment is Godrej Properties. A 5% rally on that one. It's been a one-way rally for Godrej Properties this month. It's up almost 20%. I mean, we're not even done with the 5 days of the month. 20% rally there and almost a 50% rally this year. Prakash Gaba, any thoughts here? Does it still beckon a fresh trade at 950? And anything else that you've spotted in the market?
Yes, Sonia, Godrej Property is trading at an all-time high. What a move it has seen. I think it's continuing up to maybe trying to have an appointment with around 1,000 zones. Perhaps it can go there, have a stop below 930 and trade long. I like two stocks here. I like Lupin, that certainly looks good. Maybe it's going to levels closer to 815, 820. And it's IndusInd Bank, which Anuj mentioned here. Yes, certainly looking good. It's seen a good momentum, good place to buy if it has to target beyond 1800 zones. Yes, I think I like Nifty as well. It's going up.
Okay, on Nifty as well, it's going up is the call. Gentlemen, thanks a lot for taking us through the market opening. We'll keep coming back to you. Vetri Subramaniam, Group President and Head of Equity of UTI AMC is with us now. Vetri, good morning. Thanks a lot for joining us. It's a market which has had two extremes. Till about 3 or 4 months back, it was, almost a bit of a buyer strike, especially in the broader market. The last 2 weeks, it's all of a sudden there's dollars chasing the market and the market seeing a big rally. In fact, on the index up about 12% from the lows. Your thoughts on the current state of the market?
Yeah, morning, Anuj. Well, as I always say, the market at equilibrium exists only in textbooks. In the real world, it's always about sentiment being at one, extreme end of the curve or the other. So, yeah, I mean, that's, I think, pretty much par for the course in terms of the way the market behaves. So, I don't think there's anything really surprising about that.
Okay. Good morning, Vetri. Good to have you with us today. Good to have you with us also because this is CNBC-TV18.com's first birthday. And we want to tell you that because you were one of the first to write a piece for our fledgling website. Today it's got 2 million visitors and many of them stay much longer than they do in rival websites. I forget the number itself, the average number, but that's obviously because people like you write for that website. More strength to you, more articles from you would be welcome. But to come back to speaking about markets, I want to speak about the real economy and the numbers. We got all these, consumer durable companies giving us some kind of negativity. Today, of course, Titan said that it's done well in the fourth quarter. How are you looking at the fourth quarter earnings and going into the current quarter? Is growth picking up or is it still elusive?
Look, I think on that, anecdotally, most of the companies, particularly if you look at, I would say, the automobile sector, large number of companies in the consumer sector, I think the consistent feedback from them right since September, October has been that the festival season is disappointing. They've continued to see demand trends remain slightly lackluster through the quarter ended March. And what we're also seeing is significant amount of inventory correction that's taking place in many of those industries. What we also know for a fact is that a lot of the industry, particularly those that were affected by developments in the NBFC space and the increase in credit spreads, reduced availability of credit through NBFCs, all of that has had an impact on the economy over the last 6 months. So, I think we saw this in the credit policy as well yesterday, where the governor talked about a negative output gap, talked about, a slight cut in their expectations for overall GDP growth. And to add to all of that, I think in the quarter gone by, what we've also seen now is increased concerns about the health of the global economy, starting with Europe, but also now spreading to the US. So I think overall from a growth perspective, things are muted. There is some evidence that even in the past, the Indian economy has tended to slow down going into an election, and there is a little bit of a lift that comes once the election is out of the way. Again, we've had some companies allude to this trend being visible in the past as well. So there's no reason to expect that we won't see a little bit of a lift once the elections get out of the way. But I think, there are multiple factors factors which have contributed to the slowdown, and therefore that is pretty much a reality, and I think that is what is visible when the RBI also today is taking comfort, not just from the fact that inflation is within their comfort zone, but very categorically saying that, look, there is a slowdown and we need to respond to that and give an impulse to the economy. So we have moved to that trajectory where we think the economy is softening, and actually policymakers think the right way forward is to provide an impetus. So I think that is the territory that we are dealing with. As far as the earnings are concerned, I'm not sure you will see too much impact of some of this in the fourth quarter. You may also see a little bit of a lift to the numbers, because I think the big delta will continue to come in from some of the bank names. But certainly the earnings expectations of 24-25% consensus earnings growth for FY20, I think that remains a very high bar, and we'll see how to deal with that.
So, Vetri, hi, good morning, and thanks for joining us. So, this growth slowdown that you're referring to, when you talk about specific sectors like consumer durables, autos, etc., do you believe that it is still just a cyclical slowdown, or do you think that there's a structural move on the downside which could take a couple of years before normalcy returns?
I don't think we have any evidence at this point really to think that it is structural, but certainly, different cyclical elements have come in and, hurt consumer sentiment, hurt consumer demand. But at this point of time, I would just, interpret it as being more cyclical. The good news, and again, if you see what the RBI talked about yesterday in their policy, they actually talked about the fact that capex trends are looking reasonably positive, partly contributed by a lot of spending being done by the government, of course. But therefore, in general, I think, hopefully the capex momentum will provide some succor to the economy, but it's not a particularly strong impetus, and I'm not in the camp where I believe a 25 basis point cut is what will really set animal spirits going as far as capex is concerned. I think there are more deeper challenges there, and the cost of money is not going to address that.
By the way, the market's surging now, especially the bank nifty. And some of the stocks which have corrected are making a comeback. Spoke about IndusInd Bank clearly as one. Look at Yes Bank. That's showing some signs of life once again, and quite a bit of buying happening on Yes Bank. So just keep an eye on that as well. A couple of these stocks looking quite interesting right now. Vetri, so from here on, for portfolio investors, we had tremendous 2017. I think one of the best in history. And after that, we had last year where, nothing moved. In fact, everything moved on the downside. You reckon most of the mean reversion is done in the broader market from portfolio investors' point of view? Is it time to look at some of the beaten down mid caps, small caps once again?
Anuj, the tricky part with this is it depends on what you're referring to. If you actually look at financial year 19 has ended pretty well for the index as a whole. Now, investors may or may not feel that, because there's been a fair amount of divergence in the way different segments of the market have performed, and particularly the performance has been very top heavy, with some of the heavyweights really driving the benchmark indices. So the average portfolio manager, and it's been a challenge for fund managers as well in terms of trying to keep up with the benchmark because the performance has been so narrow. So FY19, I would say per se, a lot of the investors would not be feeling as happy as the benchmark itself might suggest. In terms of where the opportunities are today, I think clearly compared to, let's say, January of 2018, mid caps certainly have moved from trading at a premium to trading to a discount to large caps. So unlike a year ago where perhaps, top down we were pretty happy to say that it's okay to stay away from mid caps, our view now is that while it may not be bargain basement cheap, it certainly entered a zone where we can, as bottom-up investors, go in and start selecting things that we like. So I think certainly that's one big delta which has taken place over the last 12 months. Similar would hold for the small caps as well. I think there's been a significant valuation correction over there as well. But overall, I would say, the markets are still sort of pricey in terms of continuing to price in very strong earnings outcomes over the next year or two. And it's not clear to me at this point of time that the economy actually has the kind of underlying momentum to generate those kind of or justify those kind of outcomes. So I think that remains a little bit of a challenge as far as valuations are concerned. And this has been a challenge, for pretty much, I would say, the majority of the last 2-3 years. Every now and then we do have a sell-off. But now if you look at the returns over the last 5 years, the returns have gradually tailed off because, that's the impact of having run the PE up very high early in the cycle. And the fact is that earnings have not really been coming through.
Okay. Vitri, on another note altogether, how are flows into equity mutual funds? They kind of gave us a scare from December, Jan, Feb. March better?
My sense is you won't see too much of a difference in that pattern. I think the good thing as far as the flows are concerned is that we're continuing to see the SIP pipeline hold on. We are seeing some, anecdotal data suggests there's been a marginal increase in the rate of SIP cancellations. But overall, I would say the aggregate pipeline of money coming in through SIP is continuing to rise. So I think on that front, we don't see a significant challenge. I think a lot of the discretionary allocations that people were making, a lot of the money that was coming from the HNI segment, and a lot of the money that was going to the hybrid funds is actually seeing a bit of a slowdown or even net redemptions perhaps in that area. But overall, as an industry participant, when you see a SIP pipeline which is 8,000 crores a year, honestly, it's something to feel good about, that Indian investors are participating in the market, and it's coming in a disciplined manner, and it's coming in a staggered fashion.
Okay, well, for now, the market is definitely picking up pace. So the Sensex is up almost 200 points at the moment, led by a lot of the banking names. So IndusInd Bank, Yes Bank. Yes Bank has been the biggest gainer this year, 50% rally there. And a lot of auto stocks also picking up now, names like M&M, Eicher Motors, etc. Vetri, do you think the worst of the NBFC crisis is now behind us? I'm asking because a lot of, we get some split opinion from different industry participants. But a lot of the stocks have recovered about 20% from their lows last year. What would you do in this space now?
Well, recovered from their low is not saying much, Sonia. They've also come off a lot from their highs. But let me put it this way. I think what's very clear to us in the NBFC space, and look, the NBFCs have always been about their ability to originate customer assets and manage credit cost. NBFCs were never about the quality of their liability franchise because they really didn't have much of a liability franchise. I think what we are clearly seeing post the developments in October, November of last year is that the NBFCs, which have very strong parentage, have not really lost access to the markets or to the banks, but certainly cost of money has gone up for them. Secondly, wherever there are NBFCs where on the asset side, when we refer to customer origination skills and strengths that they have, if those assets are granular retail assets, then the business model is holding up. But I think NBFCs where the business model is sort of wholesale on both the liability side as well as the asset side, the stocks may bounce, but I think it's those business models that are getting questioned, and I think those are the business models that will have to rejig very dramatically to be able to stage a significant comeback just in terms of the credibility and strength of the business model and their ability eventually to get access to the bond markets. But I think the retail-oriented NBFCs, completely granular on the asset side, and if they've got recent parentage, I think the worst is pretty much behind them.
Okay. Vitri, I was just looking at one of your funds, the UTI Opportunities Fund growth option. You've got a lot of corporate-facing banks, and they have been the toast of the market in the fiscal year that just ended. But, we keep getting this anecdotal, incremental bad news. The presentation made by the IL&FS group was a bit, rattling. Their NPAs are like serious. And then now Jet, we don't know, dibbly-dobbly, this way, that way. Are we pricing in too much too soon? Will there be some long tail for the corporate-facing banks?
Well, I mean, are you pricing in too much too soon is a good question to ask, Lata. And, the market does always tend to price in good news a little fast, and I'm sure it'll have a, setback in any, set of circumstances at some point of time. But I think the larger question is really one of, have these banks gone through the entire cycle of recognition of their NPAs, which was delayed quite considerably? Secondly, are they through with the bulk of their provisioning as relates to those assets? And thirdly, is there any visibility in terms of incremental recoveries either coming through the IBC or any other mechanism? My sense is that the recognition is now fairly clear. They're more or less done with that. The provisioning also has largely been taken care of. Given some of the recent developments, we may start to feel a little bit more tentative about could there be potential delays to recoveries, and I think that is something that has already played out over the last 6 months. We've had some very high profile cases, delayed well beyond March 19, which was perhaps not the expectation 6 months ago. But overall, I think if you're beyond the recognition and provisioning stage, then I don't necessarily see a significant, reason to worry about corporate side exposure anymore.
Okay, so before we let you go, Vetri, what kind of upsides do you see this market have? I mean, we're already sitting at all-time highs. We've delivered, the Nifty has delivered almost 8% gains this year. Do you see much more to come?
Well, if you read the article I wrote a year ago as well, I've always said I don't have a crystal ball to figure out what this market will do. I've been in the market 25 years and I've never known what it will do. Maybe in my early days I was more confident about being able to predict. I now know that it's virtually impossible to predict, so I don't try to do that. And I think as fund managers, it's our business to add alpha to what the market does. We've struggled to do that through FY19, so all I'm hoping for is that we'll do a better job of that in FY20. But as to where the market goes, I don't claim to know.
Okay, I think. Thanks a lot, Vetri. It's always a pleasure listening to you. Thank you very much for joining us, and do keep those articles coming for CNBC-TV18.com as well.
Oh yes, nobody knows actually. By the way, the stock of the moment really is Cipla, because like Ekta was telling us, Goa is one of the largest plants servicing to the US, that getting EIR. Now what you saw initially was after opening higher, some profit taking, but this second wave of buying which is now happening in Cipla, and second wave of buying normally is much stronger. That stock is up about almost 3% right now, so that's looking quite interesting. So just keep an eye on that. And for the market itself, fair bit of gains. Mid-caps beginning to pick up now. 0.5% gain is what you have on the mid-cap index. IT stocks also making highs of the day now. In fact, both Nifty IT and Bank Nifty fairly close to highs, so that's quite interesting. But really, the stock that's surging now is Cipla, on back of that positive news that you have after a long time, in fact.
Okay, well, let's do one thing. Let's move on and talk about the financial space. The Reserve Bank has proposed measures to develop housing finance securitization markets, and the Housing Finance Committee will be submitting a report by the 10th of August. Yashpal Gupta, the MD and CEO of Repco Home Finance, joins us now to analyze this and to tell us how business is doing in general. Mr. Gupta, thanks so much for joining us. This setting up of a Housing Finance Committee for securitization market, how do you think that would really help housing finance companies like yourself and the industry as a whole?
Good morning. See, the securitization has been a good tool. Unfortunately, in India, it is limited to only few players. Basically, historically, if you see, commercial banks are buying the portfolio for meeting the PSL requirement. Overall, the market depth is not there. So, RBI has announced a mechanism to look into that, which is a good step. But given the structural problems that are there, particularly with respect to taxes, the stamp duties, the resolution mechanism, I personally believe it's a good step, but it will take long time for it to actually make a real impact on the housing finance sector. As far as the repo rate reduction is concerned, that is good for us.
Okay. Well, actually, I was coming to that. You see money getting cheaper for you? Cost of funds?
Yes, we do. As I mentioned when I met last time to you, are about 80% are bank. So they are MCLR plus X%. In last year, the X had, fortunately, in last few days, Now, with the reduction in the repo rate, unfortunately, the last time when the repo rate was reduced by 25 BPS, the pass on by the banks in terms of MCLR reduction was only about 5-10 BPS. Hopefully, with RBI nudge, this time there will be MCLR reduction also. So we definitely see cost of funds going down for us in Q1.
Okay, well, the bankers are not so confident, sir. They're not getting enough deposits, so they're not able to lower deposit rates. I wanted to ask you about actually your growth guidance as well. You know, we spoke to Sudhin Choksi of Griha Finance yesterday. He had already lowered his growth forecast for fourth quarter about a month ago. Yesterday, he brought it down even by a little more. He said fourth quarter wasn't too good in terms of loan growth. How was yours?
Now, for us, the growth rate has been more or less constant throughout the year. In Q3, it went down because of other factors. Overall growth rate guidance we had given was initially at the beginning of the year, we were quite confident that it will be about 20%. But then as the crisis unfolded, we lowered it to about 10 to 12%. And we think that for the overall growth rate, it will be about 12%. Okay. That is what we feel. And for the current year also, we are keeping the growth rate target around 15%.
Okay, yes. So for the current year, 15% and overall, so this 12% growth rate is what you're forecasting for FY20, is it?
No, past year.
No, I am saying for the last year, FY 18-19, it was about 12%.
Okay.
For 19-20, we are forecasting about 15%.
All right. You know, the last time you did indicate to us that in the non-housing portfolio, there has been stress as well. And you are taking some corrective actions. What's the latest now there?
So there the situation remains as it is, because as I told you last time that we do not do any builder financing. So for us, the non-housing portfolio is entirely LAP portfolio. So we are doing two things. One is that we are going aggressively by using the SARFAESI and other legal tools to reduce the existing NPAs, and fresh disbursement we have slowed down. We continue to, we propose to continue with the same strategy for this year also. That is aggressively reduce the portfolio by way of recovery and use of SARFAESI, and fresh disbursement we want to limit in that section. But going forward, if in the second quarter, if our share of the LAP portfolio goes down, it is already 18.6%. If it goes down to around 18%, we may again increase it to about 20%, because that portfolio gives us a good spread. And fortunately for us, one more benefit is that with the reduction in repo and reduction in MCLR, hopefully, I am using the word hopefully, our cost of funds will go down. But because our lending model is entirely granular, so for our customers, they are not that much rate sensitive. So 0.25%, 0.5% reduction rate of interest or increase in rate of interest either way does not increase or reduce their EMI by significant amount. So what we will do is that for us, if the cost of funds goes down, we can continue to lend at the same rate and increase our spread. So that is what is going to be our strategy.
All right. We leave it at that. Thank you very much, Mr. Gupta, for joining us and giving us your thoughts on the state of the market, cost of money, and the nature of the asset quality.